Howdy, Jacob here. Today we are looking at DRD Gold in the metals and mining industry. 600 million market cap on 470 million enterprise value. So net debt is positive, or net debt is negative, meaning they have more cash on hand than debt. Founded in 1895, it's definitely been around a little bit. 169 million in 2014 to 293 million in 2023. Okay, huge jump in 2021. Return on invested capital the last 4 years has been about 20%, which is pretty great. They do pay a dividend, so 45 cents or 6.6%. What else do we have here? Let's look at the income statement. So shares are up a lot. Outside of the last 4 years, earnings have been pretty abysmal. I assume, what does the price of gold look like? I presume it'll mimic somewhat like gold. So yeah, it wasn't really doing anything, 14 to 18, and then 2020 jumped up again. Okay, so yeah, that mimics pretty close to here. Recently though, no heavy issuance of shares, which is good. They have 131 million cash on hand with 100 million total liabilities, so an extremely safe company from a balance sheet perspective. As for cash flows, their capital expenditures have been going up quite a bit recently, but we're still looking at some positive free cash flow. I'd say on a 5-year average basis, it's interesting. We have a negative 3 million, but as high as 85 million, probably averaging out to about 40, 50 maybe. 40, 50 million, paying out 27 million in dividends. Outside of that, really just a little bit of debt pay down and then a little bit of reinvestment back in themselves. So the use of cash is really mainly on the dividend side and then a bit on the reinvestment and the capital expenditures and such. So let's start making some assumptions here. I think this dividend's fine. I'm not going to raise it just because in the rolling 12, 27 million is exactly what their dividend is. But again, I think it's safe because they have so much cash on hand and no debt. So I think I'm comfortable keeping it at 45 cents per share. And then revenue growth. I mean, metal and mining probably going to be pretty darn close to inflation. So let's just do that. 3 and 13 and repeat price free cash flow. For margins, let's do averages here. Let's do 15, 13, and 0% share changes since they historically haven't really bought back shares and their stock-based compensation is relatively low. I think assuming flat shares is pretty reasonable. And that gets us to a price point that needs to fall 32% before you get a 15% return with these assumptions. I think it's a consistent company. I think although their results on revenues look pretty volatile, I think that it's going to replicate pretty close to what the price of gold does. And so if you feel good about gold, why not own a gold producing cash flow company and not just buy the gold, which is just saying someone's going to buy it for more later. You're actually buying a company that's producing cash flow that you can actually value. And so it's definitely an option. I think that, I don't see gold going anywhere, and I think that this company could easily inflate their revenue pretty close to inflation. And then, I don't think the company is going anywhere. It's been around since 1895. But yeah, I think that's the end of the analysis, and I hope everyone enjoyed the video and has a great rest of the day. Thank you.